The current stock price for Beyond Meat Inc., trading on the NASDAQ under the ticker BYND, is $1.45, reflecting a day's movement of plus 4.31% as the market is open. This intraday pop, while modest in absolute dollar terms, represents a significant percentage bounce for a stock that has been battered to penny stock territory. Now here's the insight you likely didn't expect. The reality of this recent upswing isn't a sudden fundamental reversal in consumer demand for plant-based meat, but rather the classic volatile dynamics of a highly shorted security just hours before a major earnings report. The expectation is that the company is simply another struggling food manufacturer with a niche product, but the reality is that the stock is currently acting more like a short-term trading vehicle, a crowded theater where the slightest noise can trigger a dramatic reaction. This stock has been a battleground between fundamental long-term investors, or what's left of them, and aggressive short sellers who view its business model as unsustainable. The recent price movement is the sound of that battle intensifying, fueled by the anticipation of the Q3 2025 financial results announcement, which the company has moved up to today, Monday, November 10th, with the conference call slated for tomorrow, November 11th. The common ground belief about Beyond Meat stock is a simple and painful one for anyone who bought in near the highs. The company failed to transition from a high-growth, high-multiple food investment darling to a sustainable, profitable business. The expectation was global saturation. The reality is an ongoing struggle with inventory, pricing, and a fundamental slowdown in the core U.S. retail channel. But the deeper take we need to consider is that the stock's behavior is being dictated less by its grocery store shelf presence and more by the technical setup of its capital structure and short interest. Just last month, the stock experienced one of those rapid, violent ascensions from around 50 cents up to nearly $8 in a matter of days, a purely mechanical short squeeze event, likely amplified by retail traders using platforms like Robinhood for quick, high-risk trades, proving that when the float is tight and short interest is high, fundamentals can take a back seat. That short-term euphoria has since evaporated, but the short interest remains substantial, giving the stock a coiled spring feeling leading up to any major catalyst, like today's rescheduled earnings release. The daily trading volume has been consistently elevated, a clear indicator of high institutional and retail churn, far surpassing what you would typically see in a company of this current market capitalization. This volume surge suggests a high level of speculative trading activity, making it a critical aspect of understanding the current price action, regardless of whether you're managing a sophisticated, intelligent portfolio or a simple individual brokerage account. When we examine the more immediate stock movement, Beyond Meat has been trapped in a tight range following the October spike and subsequent drop. The recent weakness stemmed from the company pre-announcing a lower-than-expected revenue outlook for the third quarter and delaying the earnings release date, a signal that rarely breeds confidence. Management is guiding for Q3 net revenues to fall between $68 million and $73 million, a noticeable decline from the previous year, which confirms the primary concern: demand has been tepid. U.S. retail sales continued to be the biggest disappointment, suffering significant year-over-year declines as the initial novelty of plant-based meat has worn off for a large segment of the population, and competition has stiffened from both smaller startups and established players like Tyson and Kellogg. Yet the current 4% jump, with earnings on the horizon, is a microburst of optimism. Is this just short-covering activity ahead of a potentially volatile report? Or is there a genuine belief that management might unveil a new, aggressive cost-cutting plan that could finally put the company on a path toward positive adjusted EBITDA? That's the tension. The market's expectation is a continued slow burn of bad news, but the stock's action is hinting at a very short-term belief in a positive surprise, however fleeting it might be. This is where investors who prefer self-investing on platforms like Fidelity or interactive brokers need to exercise extreme caution, as the underlying metrics are still flashing red. Let's ground this in the company's core business model. Beyond Meat's value proposition is simple: creating plant-based substitutes for animal meat that look, cook, and taste like their animal counterparts. They primarily sell their products, such as the Beyond Burger and Beyond Sausage, through two main channels: retail, grocery stores, and food service, restaurants. The initial expectation was that this model would capture a massive market of flexitarians, those who want to reduce meat consumption without giving up the experience. However, the reality has shown that their products carry a premium price point, often face complex inventory management issues, especially with fresh products, and have struggled with sustained repeat purchases from that crucial mainstream consumer. The strategy has shifted multiple times, from rapid expansion to prioritizing profitability, which included significant layoffs and a clear focus on operational efficiency. In the second quarter of 2025, for example, the total volume of products sold was down nearly 19% year-over-year. The raw data indicates a fundamental challenge with market adoption at scale, which is a significant headwind against any attempt at a sustainable stock recovery. It's the challenge every consumer-facing company faces, from Apple stock to the next fast food chain. But for Beyond Meat, it's about whether the market for their specific product is as large as initially projected. While the company still holds a strong brand presence, the sheer financial reports from the past few quarters, consistent net losses and revenue contraction, speak volumes about the execution and market acceptance. Institutional activity provides another layer to this expectation versus reality dynamic. While some funds have been consistently paring down their stakes, viewing the story as broken, there is still notable institutional holding, including some names that have recently increased their positions. This mixed signal is the classic market tension. Smart money is usually divided on turnaround stories. The additions could be institutions taking a highly speculative contrarian bet that the worst is priced in, or simply funds like BlackRock and Vanguard adjusting index tracking positions, rather than making a high-conviction call on the company's future. For individual investors utilizing tools like Schwab Intelligent Portfolios or any general investment help service, the institutional data on Beyond Meat serves as a potent warning about the deeply divided and high-risk nature of the stock. Insider trading has mostly been selling, which, regardless of the reason, does little to build retail confidence. The macroeconomic pressures are an unignorable part of the Beyond Meat narrative. In a period of sticky inflation, consumers are becoming intensely price-sensitive. Plant-based alternatives, especially premium ones, are often the first items to be swapped out for cheaper traditional proteins or simple vegetables. The expectation was that the plant-based movement would continue its linear growth regardless of the economic climate. But the reality is that the consumer wallet is under pressure, and perceived value trumps ideological purchasing for most. Furthermore, rising costs across the supply chain, from ingredients to cold storage distribution, have compressed Beyond Meat's already thin gross margins. The company's goal of achieving cash flow positive operations by 2026 is a massive expectation, especially when stacked against the reality of ongoing double-digit revenue declines. To manage this tension, the company has two primary levers: price and innovation. Price cuts might stimulate volume, but they will further destroy margins, speeding up cash flow. Innovation, on the other hand, is crucial, but takes time and capital, which the company is short on. The Hard Rock Cafe partnership and new value packs in Canada are small glimmers of hope in the food service and international retail channels, suggesting an understanding that they need to broaden their appeal and penetrate the lower-cost segment. The next few quarters are entirely focused on a path to profitability, which means cutting costs, rationalizing product lines, and shrinking the business back down to a core, sustainable size, a far cry from the original vision of limitless global expansion. Looking ahead, the future outlook for Beyond Meat stock is a spectrum of extreme possibilities, making it a high-stakes play in the world of online investing. The best-case expectation is that today's earnings report reveals better-than-guided revenue and, more importantly, a significantly streamlined cost structure that convinces the market that the stated 2026 cash flow positive goal is achievable. If this reality materializes, the stock could see another violent spike as short sellers scramble to cover their positions, pushing the price far above its current level. This would be a massive relief rally, not a sustainable recovery based on growth, but a technical move driven by market mechanics. The main catalyst, therefore, is not revenue growth, but cost discipline. The primary risk, however, is that the earnings report confirms the market's deepest fears: continued revenue decline, persistent margin pressure, and no clear immediate path to stemming the cash burn. If this reality hits, the stock could easily retest its 52-week lows, moving into the precarious territory of being viewed as a structurally impaired asset. The sheer amount of dilution and the capital required to stay afloat remain massive burdens. The company successfully executed a convertible note exchange that managed to push out some